committee. We're
You are
gonna
now
go
live.
on. Can somebody hit the got it button up there? There we go. All right. So this is Senate Finance. We are live finally. It is Friday, April 8th, and we are redoing our agenda. Graham is still under the weather today, so we're putting off our discussion of revenue and the budget. And we're going to go back to the state and local tax workaround, which we didn't get to on Wednesday. So I've got Abby and Commissioner Folio, and I don't know which would work better, to have the commissioner talk to us about how this would work and then Abby walk us through. I think that might be the best way to deal with this.
I'm hopeful
But
that
I'm looking at the two experts. But
I'm hopeful to have Abby go first, Madam Chair.
okay, we will have Abby go first then. All right. So Abby, can you share screen so we can
Yes.
all see what we're looking at?
I'm just checking. I'm sorry, Faith, I didn't check. I assume Faith is posted under my name for today's date. You should have the presentation.
Yeah.
Just looking. Yes, state and local tax deduction cap, the first document under my name.
Okay.
So for the record, Abby Shepherd, Office of Legislative Counsel. Can everyone see the
Yes.
PowerPoint?
Yeah, there you go.
Great. Excellent.
We've got two, we're seeing your notes, or we've got
Oh, darn.
three.
Okay, I'm not.
I've got both slides at once.
Okay, let me try that again.
Well, we see the continuum down the side, but this is definitely better.
Let's see.
No, there isn't a bill.
Yep.
No, yeah. So I did want to give you some background because the sort of genesis of this discussion has been developing over the last month. So after H510 passed out of the House, you have had some presentations in March of that bill. And I believe it was in response to that discussion, the commissioner had come in to present and compare what's in H510. Sorry, that's the child tax credit bill. And he had mentioned some of the governor's different tax proposals. And you had asked me to come back with what was in various House bills with similar, not exactly the same, but similar proposals to what the governor had proposed. And one of those in H527 was what's called a SALT deduction cap workaround. And at the time you had asked, that this was last week, you had asked me to come back with an explanation more in depth to sort of lay the background for what that is and why a state would potentially want to enact that. So let me try sharing my screen again. Sorry, I'm not fantastic with
But we can always go on computers.
Let's try this now. It's also, I have 3 different screens going. Let me just swap this.
Sounds like here.
Is that, are you seeing
that is perfect.
a full
Perfect.
screen now?
Yeah.
Is that good? Okay.
That is good.
Perfect. Slide this over. Okay, so that is the background. There is a proposal in H527. And what 527 does is in response to different federal legislation. So I'm going to explain what is the SALT, why is it called SALT deduction, and why is there a cap? So in the federal personal income tax, you start with income, which is, you start with gross income. That's all income from whatever source derived. I've provided the Internal Revenue Code citations here. Taxable income is gross income minus either the standard deduction or itemized deductions. And one of those itemized deductions is for certain taxes paid. There's a whole list of them. I've included the primary ones under the general statute, and that is the Internal Revenue Code Section 164. So there is a deduction available for itemizers, so individuals who itemize their deductions for state, local, and foreign real property taxes, state and local personal property taxes, state, local, and foreign income or profits and excess profit taxes. Also, in lieu of the state and local income tax deduction, individuals can elect to deduct general sales taxes. There are some other taxes that are deductible under this deduction, but I didn't want to get into all of those. That's not the most important part of this discussion. So it is colloquially referred to as the SALT, which is state and local tax deduction. Tax Cuts and Jobs Act at the very end of 2017 created a whole set of changed all of this framework. It changed a lot of the personal income tax code, as you're aware. The way that the Tax Cuts and Jobs Act affected this particular itemized deduction was twofold. It disallowed any foreign taxes from being taken as part of the deduction, and it capped the aggregate amount of the taxes that could be deducted in the taxable year to $10,000 or $5,000 for individuals who are married filing separately. So that means it applies to state and local real property and personal property taxes, state and local income taxes, or if an individual elects the general sales tax. And then there are several others, but the primary change was to no longer allow foreign taxes and to cap the amount. There has been most recently a proposal to cap the deduction at $80,000 of taxes paid or $40,000 for married filing separately. That was in the Build Back Better bill that, as you're aware, only passed the US House. It did not pass the US Senate. I believe there are individual members of Congress, and I believe it's in the House, not in the Senate, who have proposed other variations of the cap, but none of those have moved in any way. So those are not really at play at the moment, although there is quite a bit of debate, and you may have seen that in different news sources.
Question?
Yep, Senator Sorokin has a question.
Before it went down to $10,000, was there any cap on SALT deductions?
No, there was not. I
And
don't believe, no, because this still exists. There are other itemized deductions that have caps and floors, but this one does not.
And it's a huge change from, well, the first step into 2018 was a huge change, but going back from 10,000 to 80,000, isn't that a major shift?
Yes, I'm really not the best place to talk about the revenue impact. Graham would be able to speak to that, or perhaps the commissioner could, but that was certainly one of the revenue saving provisions in the Tax Cuts and Jobs Act, putting this cap in. So changing it would cost more to the federal government.
And one last question. If the SALT cap had gone up to 80,000, would it be by definition that we would piggyback in terms of the Vermont tax, or do we have a choice how to do that? So
that leads perfectly into my next slide. Vermont made several changes. One, the year before the Tax Cuts and Jobs Act took effect. That's when taxable income was moved to adjusted gross income. That's the starting point. The second change was in response to the Tax Cuts and Jobs Act, and that was to decouple from federal itemized deductions. So Vermont no longer pulls in every federal itemized deduction. Instead, there is the medical deduction, and then Vermont has created its own personal exemptions because those were suspended under the Tax Cuts and Jobs Act. So that the import of that is that Vermont's revenues are not affected by this deduction in any way, either the deduction itself or the cap. The impact is for taxpayers who now are paying more in federal taxes.
So I'm sorry, I'm still on the uptake here. So does that mean that do we have our own SALT deduction, a state comparable thing, a cap on SALT? Or am I missing?
No, so Many states do add back if they start with, say, federal taxable income, that would have allowed the SALT deduction, but the individual owes that income or those taxes to the state. So many states add back what was deducted federally. Vermont starts with adjusted gross income, so there aren't all of these deductions allowed yet.
So
And
we
then
have
Vermont
no-
determines what.
We have no SALT deduction in Vermont. It's not like it's capped at 10,000. We have none.
Correct, there's nothing. Yes, that's
No,
right.
this has always been a federal, and it was seen as primarily impacting blue states,
Right.
northern, east and west coast, because we tend to have the highest property and income taxes. And this was one of the prime reasons that when we saw people in upper income brackets, you've got two young professionals working, they buy a nice house, in Shelburne, they are paying significantly more than $10,000 in state and local taxes, and they lost that. So they were paying more under the tax cut and jobs bill. And this states have been trying to find a way to work around it, but it's it's what you can deduct from your income before you calculate your federal income tax. We don't have
Yes, that's absolutely correct, Madam Chair. I'm just trying to think, because we wouldn't create a deduction for the taxes that the state itself is imposing, unless it were sort of a local tax deduction.
So the last bullet, Abby, however, the federal cap still impacts Vermont tax who itemize federally and pay more than 10,000 bucks, thus increasing their tax burden.
Their federal tax
Does
burden.
the federal cap impact Vermont taxpayers on their Vermont taxes?
No.
Oh, okay, that's what I'm trying to get at. Okay.
Yes, sorry. This is multi-layered and it is complex. Yes, thank you for clarifying that.
So
the
Madam Chair,
last,
yeah,
I'm just wondering, like, not to get ahead, but if we're trying to deal with state revenues, what can we do here that could affect state revenues?
we're not impacting state revenues. This was a way, I think there's the student interest deduction. These were several things that the
Right.
governor had proposed that didn't move.
Okay.
This one, to me at least, sounded like something we might do. We're doing a lot to
I
help
see.
lower income people. This might help those folks we're trying to attract here, young professionals.
Right,
I don't know how much money you have to pay $10,000 in property taxes. In Chittenden County, I haven't gotten my reappraised house yet, but in Montpelier, my house, which is not a McMansion, is coming close to $10,000 in property tax. So it's,
Well, that's interesting. So are we saying that we could do something in this area and help middle income people with their federal taxes?
yes,
And that's no skin off the Vermont revenues at all?
that's my understanding.
Why wouldn't we do that then?
Well, that's why I thought we might want to look at this a little harder. And we keep talking about equity. There's equity on all sides. Okay.
I'm missing something. I don't have,
But
but Abby has more than.
yeah, she does. So we'll keep going.
would you like me to continue?
Yeah,
Could I ask a question, Madam Chair?
yeah, there you are. Yes.
Abby, so Senator Sorokin just had a rather interesting point, and is he? Maybe I'll just restate it because I could well be missing something. This is a potential change in state law that wouldn't impact Vermont's revenue, but could mean Vermonters pay less in federal taxes. Is that accurate?
No, not exactly. So
It's never that easy.
the
That's what I was
proposal,
trying
which
to do.
That's why I didn't think what you said was.
It's too easy.
I cannot speak to whether it would be revenue neutral. That you do need to hear from JFO. I don't know if the commissioner has more details on that.
And
It
this
would
is a
not-
workaround, so it's,
It would be at the Vermont level, so it would be a Vermont benefit. It's both a tax and a credit, as I'll lay out in the next few slides, but it wouldn't be it's not a direct link to federal taxes. I don't want to make it sound like Vermont is paying individuals federal taxes. I just want that to be clear.
why don't we walk through what it is, because it's a workaround. So
It is.
it's more complicated than that, and I think the first thing we just would need to know is what is it, and then we can ask questions about it. Okay.
Yes. So other states have come up with some different creative ideas. And this first slide, and I don't want to get too into the weeds about this because this was the first attempt that was not successful. So the first attempt was using charitable contributions. Those are deductible, including when they're made to state governments. However, the IRS disallowed that and said, no, that there's a quid pro quo. The taxpayer is making a contribution with an expectation of return of receiving a tax credit in return. So the deduction is disallowed to the extent that the individual is expecting a state tax credit. That was sort of the first wave of workarounds. The second wave, however, was what has since 2020, the end of 2020, been sort of blessed by the Treasury Department and the IRS. And that is the proposal that's in H527. And it started with Connecticut, which is, that was the first state to propose this. And it is the only state that I'm aware of that does impose a mandatory tax like this. So the way that states have crafted a workaround is to impose either mandatory in the case of Connecticut or an elective entity level income tax on pass-throughs that are doing business or have income somehow connected to the state. The state will then provide a corresponding and offsetting tax benefit to the individual members. So pass-throughs, and I do lay this out a little bit later, but when I'm going through the H527 language, but remember, a pass-through is an S corp or a partnership or a limited liability company. They are made up of individuals who pay individual income tax, not C corporations. So the pass-through in this workaround is paying an entity level tax, and then the individual members of that entity receive the tax benefit. Different states have structured it in different ways. Sometimes it's only a partial credit, sometimes it's a full credit, it could be a deduction or an exclusion. Many states have enacted these since 2018. The last most updated count I saw was 22 states. There are a handful, I believe 5, that have legislation pending. And as I mentioned, Connecticut was the first state to propose this, and Vermont did have a proposal in H527. So before I jump into and maybe that's what your questions will be about, but I'd just like to pause before I start walking through what H527 does and how it's structured, because that is one option, but it is not the only way that states have structured these workarounds.
So this pass-through entity would be this giant partnership in which Vermont taxpayers would contribute the amount of their state and local taxes, and then they would get a tax credit at the federal level?
No, at the state
No.
level. So it would be Vermont
At the
imposing
state
a tax and then offering an offsetting, in this case, credit, is how H527 is structured.
So they get a credit, which they could then give to their local town clerk. And I assume this pass-through entity would eventually pay the town clerk, or I know, or,
Nope. So this is would be administered as part of the income tax. So it will be all done through the Department of Taxes. So it's a new entity
All
level
right, but
income
how,
tax
all right,
on.
it's gonna take a little, I'm gonna need a picture. Just to see where the money,
Mhm.
we're gonna have this Vermont pass-through company. And I'm going to pay my income tax and maybe my school-based tax into that property tax? Or is this just going to help me work around my income tax?
So it's really a workaround for income.
I think I pay more property than income, but. All right, we'll
Yeah.
keep going.
Sorry, I think there is a question.
Yeah, Madam Chair.
Yes, okay. You just
So-
have to holler, Chris, because I only get one picture, and as long as Abby's talking, she's it.
Well, that's a better picture than me. Abby, is this benefit, this scheme here, and I don't mean that in the dismissive way, but is this end up creating a benefit only for people with some kind of LLC or partnership? This is, in other words, not a benefit to the great majority of Vermonters, but it is allow a benefit to those that have some kind of entity.
Yes, so it's only if there were a pass-through entity of which an individual taxpayer is a member, either as an S corporation shareholder or a partner in a partnership. When there is income that's distributed from the partnership to, and that's, sorry, distributive proceeds, that's net income, dividends, royalties, interest. Oops, I'm sorry, I didn't mean to go ahead
Okay,
on that
so
slide.
your average professional person, tech person, working for wages that have good wages and have bought a nice house, and they are paying $20,000, $30,000 in income tax. This is not, or income in property, probably the bulk in property. This is not going to help them unless they belong to a partnership, like a legal firm. Or is this going to allow people to set up partnerships? That's what I
The
thought.
latter, yes,
It
no, it's
was
more the latter, and
You're gonna
maybe
set
the,
up a partnership, the sole purpose of which is for me to pay in my taxes and then get a tax credit back out, which can then be presented to the feds.
no, so that would, the
Keep
tax
going.
credit that would be.
I'll get it as we go along.
Absolutely. No, these are great questions. It's, laying out the whole structure really. So it would be against the Vermont personal income tax. It's a refundable income tax credit. So it doesn't matter what the individual's liability is.
Okay. So I could pay in more than my liability? I mean, there's no reason why I would do this if I were falling under the $10,000 cap. So this would
That's
only benefit people that owe more than $10,000 in state and local taxes. But I guess we'll just keep going. I'm struggling with where the partnerships or the pass-throughs come from, but keep going and we'll see what happens.
Okay, so as you've just parceled out, it does only apply to these entities. At least one member of the pass-through entity must be liable for income tax in Vermont. The rate that's imposed on the distributive proceeds, so the income from the pass-through, is at the second highest marginal rate for income tax, which right now is 7.6%. And then the tax, as I mentioned, is not mandatory, or perhaps I didn't mention that this particular proposal is not imposing a mandatory tax. It is elective. So it's upon the consent of either each member of the entity who is a member at the time the election is made, or any officer or managing individual who is able to make the election. And again, there must be at least one member who is liable for income tax in Vermont. The next two bullet points are more related to the administration of it. The election must be made annually on or before the due date for filing the return. It can be revoked as long as that's done before the due date. And a pass-through is required to report to each of those members of the pass-through what their share of the distributed proceeds are for that taxable year. It also lays out how this works, and this is where it gets a little more complex. It lays out how it works with C corporations, as you've just worked through a lot of the corporate income tax structure. There is some interaction with having C Corp members of a pass-through. And when a pass-through is a member of a unitary filing group of a C corporation, so when it's the C Corp that's the parent, then that means that the pass-through would be included in the group by default unless all members of the pass-throughs are taxpayers that are liable for tax in Vermont, or no business entity is taxed as a C corporation that has direct, indirect, beneficial, or constructive ownership or control of the pass-through. So that's maybe more detail than you wanted to get into. Again, sorry, I'll pause there. I can't actually see your faces.
I think we're still
on the bigger picture. Okay, I will
trying to picture what it is.
Go to the next. Yes. So yeah. I'm probably could have left that slide out. That's probably more detail than you wanted. That was more on the sort of getting in the weeds level. So first we saw it would impose an entity level elective tax. Next, you get at what is the benefit? How is this actually helping taxpayers? So the entity pays the tax, and then there is a refundable income tax credit allowed to those individual members of the pass-through. And the amount of the credit is the members' pro rata share of the taxes that were paid at the entity level. This language did also create a credit against the corporate income tax in case there are any C Corp members of a pass-through. And then I've laid out some of those rules about how that works for different corporations. Again, the amount would be the C corporation's pro rata share of the tax paid.
I think we should attach this whole thing to feminine hygiene products.
The final slide that I have for you, and then I can maybe stop screen sharing, that might make it a little easier to see. There is also a credit allowed. There is currently under Vermont statute a credit allowed for residents when they're paying tax in another state or province. So this sort of has some conforming changes there, and also allows the credit against tax imposed by another state on a pass-through entity, as long as they also offer the SALT deduction cap workaround. And again, it would be the amount of tax that the individual member paid when it was paid at the pass-through level. And I will stop screen sharing.
Okay. I think I'm going to look to Commissioner Bolio and see. I am still struggling, I think, on slide 1.
I
You've got,
am as well.
okay, we've got 50 people in Chittenden County that pay $20,000 a piece in, and this would only be income tax, right? Not property. So you would have to owe, so this would work you around, you'd still have to count the money you paid on your local property tax as that would count as income, can't deduct it from your feds. So would this oblige a bunch of savvy people to get together and say, if we form a pass-through, we could do this? Or is this an organization that the state sets up and any Vermonter who wants to can join it?
Thank you, Madam Chair. For the record,
I
Craig
like
Boley,
to
with
share
Tax
the
Commissioner.
confusion.
I hope it's obvious now why I wanted to go second. Let me try to work through some of this for you guys.
If you can't explain this, Commissioner, we're all in trouble, so.
So, this is a really interesting topic. It's salt cap workarounds are sort of the Wayfair of the 2020s. I think the IRS blessed this approach, I think, as Abby said, November of 2020. And so now we've had over 20 states, 22 or 23 that have passed this, another maybe 10 that are thinking about it. States generally love the SALT deduction because in a simplified way, it makes the federal government subsidize a state's taxing capacity. So once states realized that there was a way to work around it for a share of their population and improve affordability for that share of the population, it's sort of taken off like wildfire. It's not so much that there will be individuals who earn wages who will create partnerships, right? Because you need actual revenue and expenses within that partnership to make it work. But it's that this structure essentially could exist for people who happen to belong to partnerships. And in a simplified way, I was chuckling as well as Abby was presenting, because I think I heard both Senator Sorokin and Senator Pearson sort of like, why wouldn't a state do this, right? And it sort of sounds like a free lunch. And frankly, when I first started looking into this, I thought it was too. I'm going to rain on the parade a little bit, but you can get it pretty close to a free lunch. And I think that's why so many states have found this really attractive. So think about a partnership that has just one partner. Let's make it easy. Just one individual partner. And they have, let's say, $1 million of distributions from that, right? So under a pass-through entity tax, that entity would pay almost $80,000, right? And there's no SALT cap at the entity level. So they could deduct that full $80,000 of entity taxes paid on the pass-through entity return. Pay the tax on that, and then distribute the rest of that income to their individual owner. The reason you give them a credit on the other side is that they already paid the income tax on that $1 million of income, right? They paid it at the entity level. So you give them an $80,000 credit at the personal level. Now, it is true that the federal deduction does not interact with Vermont state income taxes, and that's because we don't recognize the federal itemized deductions anymore. But there is an impact to this, right? Take that same entity that I just talked about with $1 million of income. They would now be distributing about $920,000 of income, right? And so without the pass-through entity tax, that entity would have distributed $1 million of income, say, because they would have passed it all through, no entity taxes paid. And the individual would have only been able to deduct $10,000. So in that case, even though Vermont does not recognize itemized deductions, that individual taxpayer would be reporting to Vermont about $70,000 less in taxable income than they otherwise would have. And that's how that individual gets the benefit at the federal level, right? They've reduced their federal taxable income by an additional $70,000 over what they could have deducted from the SALT cap. So really what that means to this discussion is that I think there's a lot of questions to answer before the legislature could move forward with this. I don't think that you can just take the language from 527 and you're good to go without doing some additional work. But I will say, the administration is still open in concept to the SALT cap workaround. My one sort of hesitation is the amount of work that it would take to get it done and the amount of time left in the session. I'm not sure that you can get there. Mm-hmm. And certainly the governor's preference would be for the legislature to first focus on provisions of the tax relief package that he put forward. There's two main elements of 527 that I think have to get answered, and sort of maybe one big foundational question to ask before you even get into that work. The big foundational question is, are the feds going to do anything to adjust the cap, right? Not to editorialize too hard, but I always chuckle about something that you have to call a workaround in government, right? That's never really where you want to be, but we're in this spot because there is a mechanism to get around this limitation that the federal government put in. And as Abby said, there have been some discussions about expanding that. I don't think that there's any way to say there's meaningful belief right now that the feds are going to change this imminently. But for instance, if the feds did make the cap 80,000 as had been proposed in Build Back Better, I don't think we'd be here talking about this, right? Because the population who would be able to take advantage of this would be so small that I don't think it would be worth it. And if the feds do nothing, this $10,000 cap expires, I believe, after tax year 25, right? So unless the feds take some kind of action, what we're talking about here is likely temporary. And the first thing that I think
it would be a lot of work for 3-year benefit.
Well, and the benefit is meaningful. I'm not saying that's not a reason not to do it, Madam Chair. I just think we've got to be mindful about that. I think that there is reason to talk about doing it because the feds did not pass Build Back Better. As we were putting together proposals for this year, that was sort of one of the questions. As members of this committee know very well, the Build Back Better debate went well into the holidays. So it was challenging to understand where that would be. So, I do think it's worth talking about. But I think one element of work that has to be done with the language in H527 is how do you structure it so that it's revenue neutral? Or is the legislature okay with it costing some amount of money? I don't know what that amount of money is, but the dollar for dollar credit that is in H527 likely would create a general fund hit. There's 2 ways that I've seen states do it. The first is to, and I'm going to get twisted around even saying how they do this. So they allow a credit, but the credit cannot be more than the amount of taxes would have been on that same income for that taxpayer's personal income tax. Frankly, that feels like an absolute nightmare to administer. The easier way that states have dealt with this is a little rougher around the edges, and maybe it doesn't wash out in every case, but they simply don't offer a dollar for dollar credit, right? So some states offer you pay $100,000 in entity taxes, but you only get 90% of that, or you only get 80% of that as a personal income tax credit. And the goal of that is to sort of wash out the fact that they're going to be reporting less to the state in taxable income and still have it wash out for the state. It does take work to do that and work to model it. I will admit it's not work that we have done at tax, and I don't want to speak for JFO, but I don't believe they've done a lot of work on that yet. The other element of language in 527 that I would encourage the committee to think about is actually probably easier, which is, as Abby pointed out at the end of her presentation, it allows corporations to claim the credit. I'm not sure that's a great idea. Right, the workaround here that we're trying to do is the limitation on individual SALT caps. Adding corporations adds complexity for administration. And I don't know if it creates situations that would game the system, but it does create sort of a problem to think about at that point. What do you do with a partnership that has an individual owner who could take advantage of this and a corporate owner that, if the language doesn't allow for it, couldn't take advantage of it? Years ago, we used to have partial composite filings with some residents and where different non-residents of non-resident owners of partnerships could elect different treatment. And I've got to be frank, it was an absolute nightmare for administration, and we discontinued that years ago. So I think the easiest path on that, though recognizing it would limit the ability to take effect, would just be to not allow partnerships that have any corporate owners to make that election. And the last thing that I would leave folks with, and why I think another reason this is really worth at least thinking about, is I believe Senator Pearson correctly highlighted an equity issue that, this doesn't create a structure for wage earners to be able to do this. I think if you can do it in such a way that it does not impact state revenues, but provides that additional affordability at the federal level, that's why many states have found that attractive, right? You're not hurting the wage earners. You're just not able to offer them the same thing while you're improving affordability for some who own the partnership. But there's another equity issue here that exists today under current law, which is that we have this regime for non-resident owners of Vermont pass-throughs, right? It's called composite filing. And they have to pay non-resident withholding and then file personal income taxes. But non-resident owners of Vermont pass-throughs can elect to pay composite, which means pay the tax at the pass-through level. So today, essentially, this structure that allows you to work around the SALT cap exists for our non-resident pass-through owners, but not our resident pass-through owners. So I do think that there's an existing equity issue there as well. And most states have some kind of composite partnership election. So I suspect that that's another reason that those states have found this attractive, is to shore up that equity problem as well. I've said a lot, and I'll pause there. I'm happy to try to help work through any additional details or questions on this.
Okay, Senator Sorokin.
Thank you, Commissioner. Do you have any idea from the states that collected, or the feds collected a lot more taxes as a result of the 2017 law, what the numbers involved, what the numbers might be for Vermont in terms of what you could potentially save for middle and high income Vermonters by enacting something like this?
I don't have those numbers handy with me. I'm sort of trying to think out loud a little bit here about how we could get that. Let me take that back to my team and see if there's something we could do on that. It's not work that we've done yet.
Is it something that other states we could extrapolate from other states?
Very possible. Very possible. Yeah.
And is there, and the follow-up question, I know is going to send you into a tizzy, but if we were to save tens of millions of dollars for higher income people by making this change, is there any way we could add something on where they pay an additional tax or something to help our revenue picture in order to get this?
That's sort of an interesting question. I believe that might happen naturally for you, right? So, yeah, I appreciate you asking me that question, because I think there's a point here that I could have touched on in my testimony, and I can speak to it now, right? Oftentimes, only those who have significant amounts of income are going to be over the marginal rate that exceeds the composite rate, right? Most people, when they pay the 7.6%, that is higher than what their individual income tax rate would be. So I think what you have in these regimes, at least in the way that it would be structured if it was 7.6%, but I think in a lot of states, what you actually have is people who are making an election to pay their state more income tax because it is more than offset by what they get federally. So I'm not sure you guys would want to sort of tack on more to that, because they're already going to be helping out the state by making that election. And in the states that have made an election, right, that's going to prevent those who do the math and say, nope, that's not worth it for me, from doing that. But many of those folks who do make that election are actually going to see higher state tax liabilities, but it'll be more than offset by lower federal tax liabilities.
So you're saying by doing this, that the state revenues could benefit?
If you structure it properly, yes. Because again, the biggest challenge that you have is how do you make it revenue neutral with the credit that is received and the lower income that they're going to be reporting. If you structured it in such a way that you don't have state revenue leakage there, it's likely that those people who make that election are going to be seeing their tax liabilities go up. I haven't run the numbers on all of these examples, but as I've been thinking this through, I believe that's how it's going to shake out on a general or an aggregate sense. But the key is going to be right, structuring it so that you're not having a big discrepancy or a big general fund hit by the fact that those folks are reporting less taxable income because the partnership is distributing less income than they would have without the pass-through entity tax. It's really complicated.
Okay, so it sounds like this is an interesting concept, but it's not really ready for prime time. It needs.
I think you'd have to do some more work on that. I mean, and the reason it's interesting, right, is again, like almost every state is doing this. I think it's fewer than 10 states haven't at least thought about or considered this legislation, right? So Again, it's about as close as you can get to a free lunch, but you got to do the work to structure it properly, and that does take some work.
Okay. So I've got Senator McDonald and then Senator Brock.
If we were successful to come as close to a free lunch as possible, would this widen or narrow the gap between wage earners and those who are near the top?
What do you mean by widen the gap?
Will the rich be getting rich and the poor being falling farther behind?
Yeah, I mean, I concede that this structure allows pass-through entity owners an option that is not available to wage earners on this. The challenge that the legislature would have is that enacting a similar kind of credit for wage earners would have a very direct general fund hit. And I think that that's why states have found this structure attractive, is that you can get it very, very close to revenue neutral. And it doesn't impact a state's revenue in the same way that enacting that credit for a wage earner would.
So does the gap get wider?
I'm not sure I'm in a position to answer that, Senator. I'm not sure that I can answer that question. You're asking a very big question for a very narrow element of tax policy.
This would benefit people that worked with or part of a pass-through entity. For folks working as employees of a corporation or a business that was not a pass-through. And the bulk of Vermont businesses are pass-throughs, right? Like a large percentage are
Yeah, I mean,
pass-throughs.
I think we've got probably 35,000 pass-throughs in Vermont. So yeah, most businesses are pass-through businesses in Vermont. That's true.
Okay, so if you work for one of those businesses, you're okay. If you work for XYZ company that is not a pass-through, but you make very good wages because you're a very skilled computer programmer, you will not have this to avail yourself of. But the average guy out digging your ditches or fixing your car is and this, I assume, would have to be like $10,000 in income tax. If you can't add your.
Well, not necessarily. So let me clarify two things. So it's less about the employees of the business structure, it's the owners of the business, right? So it's got to be an owner of like a partner or a member of an LLC or an S corp.
Okay, so
But
no employees.
Yeah, and it is not only people who have more than $10,000 of income taxes, right? Because as Abby had pointed out, the SALT cap includes things like property taxes. And so you would still be able to deduct your property taxes, right? There could be a situation where somebody pays $5,000 of property taxes and $6,000 of personal income taxes. And right now they'd be capped at 10,000 instead of 11,000. And this workaround would allow them to get the full benefit of these 6,000 income taxes.
Tax under 10.
Yeah, and they would still be allowed to deduct their full $5,000 in property taxes on their federal personal income tax return.
Okay, but I don't think, $5,000, at least in many Vermont communities, is not much of a property tax. More things, thank you.
I think you're right, Madam Chair. I mean, I think that's one of the reasons that this is an attractive structure for many states, right? If somebody paid $9,000 in property taxes, right, and had 5 or 6 or 10 or 20,000 in income taxes, they're still going to get up to $10,000 of deductions for any additional income taxes they pay that are not related to their pass-through entity or property taxes. So it doesn't take away that deduction at the federal level. You still get that, but it carves out, in a way, any income related to a pass-through entity where this election has been made.
Okay. Senator Sorokin.
Commissioner, thank you. So why, when we heard about this in 2017, it became somewhat political? They said it affects like coastal states more than it does
States.
the elimination of the SALT deduction. Is that because we have more pass-through entities
No.
proportionally?
No, I think it was the cap that affects like Northeast states more, and that's because they have higher taxes.
Higher
You have
tax?
more states that, again, right, the SALT deduction sort of allows, or I don't know if allows the right word, but has the federal government subsidize a part of a state's taxing capacity, right? And so states that have higher taxes like the SALT deduction more, because that's helping affordability for their own residents without, while still allowing the states to have that taxing capacity. So I think the SALT cap workaround, I don't remember exactly when Connecticut passed the first one, but it really started buzzing in 2020 when the IRS deemed this method allowable.
So, when we talk about income inequality and this favoring wealthier people, I think the distinction here is the people that are going to be helped here are specifically the people got hurt by the federal thing. So we're correcting something that came down from the feds that hurt a group of people, and we're trying to right the ship partially or fully. So it's not exactly like there's no history to this, recent history to this.
Yeah, I mean, I think that's a fair point. I mean, I think, again, I'm speculating a little bit, but I think the other reason that states have really felt that this was an appropriate path is that, often in state government, what you guys are doing is balancing. If you put resources in one place, you don't have them for another place, right? It's opportunity cost. But again, with this structure, you're not significantly impacting state revenues. So you are going to be improving the affordability picture for a subset of residents, but it's not requiring you to cut programs for other residents, right? It just takes some work to structure it in a way that is revenue neutral within your state, or as close as you can get to that. And so, I concede that it's business owners that can benefit from this, but it is not at the expense of other programs or other areas of the population that you may want to use state funds to help out and support.
Madam
Yeah,
Chair,
we've got to wrap this up. in
we
3 minutes.
understand it, but the suggestion made was that wealthy people were harmed by the tax cut of 2017. And somewhere. But the tax cut of 2017 gave huge benefits to the wealthiest. If one of the losses they got was this $10,000 cap, it was the people who got these big tax cuts would say that was a small price to pay for the money that we got in this tax cut.
Not all the wealthy got a tax cut, and I remember the charts. And there were significant numbers in that $200,000 to $300,000 range that did not see a tax cut. And when we asked why, it was because of this. But I remember asking and being told, if you owned a business, a lot of the tax cuts went through that, but that some of the just basic wage earners, and that's, a couple making good wages. You could be 2 doctors or a doctor and a high specialty nurse, and you get kicked into that upper wage bracket. These are also the kinds of people we're trying to attract. So, and it makes it, it's easier for people to vote for state and local taxes if they know they get to deduct them from their federal taxes. If they can't, it's a little harder. So it's not a they, them, and us, and there's a clear line, and everybody above it lost, or won, and everybody below it lost.
You were asking yourself which side to get on. It's pretty darn clear that the chances of you being a big winner were being on the high side rather than the wage.
But there were also winners on the bottom level.
There were, Madam Chair. always a winner on the bottom side. That's how we justify giving more and more money to the top side.
Okay, the commissioner has to leave, so Senator Brock has been waiting patiently. And then if there's a question, then we'll take it, I think, if he can stay for one more minute, but
No problem, Madam Chair.
we're not voting this out today, guys. This was purely exploratory. Okay, so Senator Brock.
My question, Commissioner, is you mentioned that this is not quite ready for prime time. There's some additional work that has to be done by your department. My question is, do you have sufficient time to be able to turn around whatever answers that you feel would be useful for us to be able to vote on this so that it gets enacted this year?
So, and I would, one thing I would clarify there, I don't think it's just my department that has to do that work. I mean, we would need to work with JFO to structure this and model it. It is aggressive. It may not be impossible, but I do think the biggest challenge to this is the amount of time left in the session, right? The House didn't take this up and do any of this work on this at this point. So I do see that as challenging with the amount of time left to answer all of the questions that we would have to answer. But I don't.
Well, I think that's essentially my question is, can it be prioritized sufficiently? Because it could be a significant benefit for at least some Vermonters, and it also is something that's revenue neutral, and that's something that we don't see very often.
Yeah, agreed. I mean, I think I'd have to discuss with the Joint Fiscal Office to see what the capacity would be for them as well.
And I think right now, being the end of the session, Joint Fiscal is probably pretty strapped, but I'll let them speak for that. Senator Pearson, and then we're going on.
But before we ask the Commissioner and JFO to take on big task, am I right in hearing that the research and the work involved, not just in giving us estimates, but that the particularly tricky dynamic is tuning this so that it is in fact pretty close to revenue neutral? That's my impression, but is that part of the fact pattern?
I think that's the big question, I think, Senator. Yeah. I mean, well, so there's a question that is squarely in the legislature's lap to answer, which is what mechanism, well, A, do you want it to be revenue neutral? Assuming that you do, then the question is, what mechanism do you want to use, right? Do you want to use an add back? Do you want to use a scaling of the credit? Do you want to use something else I haven't thought about? And then once we have sort of a direction on what that is, then it's modeling that with the Joint Fiscal Office, right? If it's a credit scaling, what's the right percentage of credit? That's the question I don't have the answer to.
I would just say, Madam Chair, given the workload and the timing, this is not a priority for me.
No, it's been interesting. It's been talked about. It was the governor's proposal, so I think I'm going to leave it to the governor to decide all those things about revenue neutrality, and if and when they get it worked out, bring us, a worked out proposal, and we can see where it goes. It's an interesting concept. It doesn't help everyone, but it helps some people, and not people we generally try and help. So I think, Commissioner, I think I'm going to toss this ball back into your park and let you decide what you want to do with it. It would be very difficult for us, and I'm quite sure for JFO, given all the moving budget parts, to get this done. I've been told the budget and our revenue bills have to be out by a week from today. So we can, do some other bills after that, but that's because we've got big spaces and we're going to have some long-term committees of conference, it looks like. So committee, I'm going to move us on. We've got next is Julia Richter has joined us. And this is 737. This is the yield bill. And Senator McDonald has an amendment. I think it came out of our discussion last Friday. And then Julia, who is, Abby, did you draft the amendment? Or Julia? Abby.
Good afternoon, Julia Richter, Joint Fiscal Office. We have done some analysis following last week's discussion that we thought may be helpful in terms of moving the conversation. From my understanding, I'm not aware of an amendment. We haven't.
Don't have an amendment. Okay.
We just have the I just have a lot of the analysis that was discussed last week.
I've got McDonald amendment, but I guess that means that we're getting the analysis on Senator McDonald, I believe last Friday, was talking about what it would take, what income level or house value level it would take so that I think we heard 80% of Vermonters were eligible to pay based on their income, but only 68, 67% actually got a check back or a reduction in their taxes because their taxes were below the percentage of their income they're limited to.
That was one of the reasons, Madam
Yes.
Chair, that's correct.
So, yes, so what were you wanted 80%?
Last Friday, we discussed what Julia had prepared, which was to say that if we move the appraisal value on homes up to $400,000, that would go towards restoring 80% of the citizenry to pay their school taxes based on income. And I asked at that point that perhaps we could look at a proposals that move the $90,000 up and took a lower bite on the home appraisals. And I think when we left, we were asking for perhaps 4 different scenarios so we could compare the differences. There was, sure, you're correct about some people don't choose to do it based on income because they get a better deal on the property tax itself. But there was one other item that was brought up that many people fail to get this benefit because they filled out the forms incorrectly. And one of the questions that we need to answer is the people who fill out the forms incorrectly are probably folks who do not have accountants doing the work. And how does the tax department, or how do we see that these mistakes don't, or make an effort to see that these mistakes don't leave people overtaxed because out of failure to have an accountant or being less well-educated. So those are the issues that are sort of.
So we have one issue, which is support services to make sure that the forms get filled out or directions are clear.
That might restore some people.
That might restore some people. But is your goal, your definition, that 80% pay on their income, is that 80% of the people will see a reduction in their property tax? Because 80% are eligible now. Their income is below the income level. But some of them may live in single wides and their property taxes are not equal to the percentage of their income they're limited to. Is your goal to have 80% of the people see their property taxes reduced?
Just let me try this one.
I thought it was a yes, no answer.
Oh, I have an answer to that. 80% of Vermonters paid their school taxes based on their income and their house appraisal. And in the past dozen years or so, fewer Vermonters have paid based on their income. The result is that the Ed Fund provides state aid, less state aid to that group of people, and the money that it does not have to spend on that group of people is spent to reduce the property tax on people that are not eligible and live in more expensive houses. That is a cost shift of state aid from the 80% of Vermonters that used to receive a certain amount to a group of Vermonters that didn't used to. And it's a cost shift.
You're bringing up my old debate training, Senator. The first thing you said is that was a cost shift. I don't know that, and when I asked last week, nobody seemed to know that in fact, 80% of the people back in the golden days actually saw, what you're talking about is not that you're paying based on your income, but that you are actually seeing your property taxes reduced.
Now, Chair, that is a perfectly reasonable question to ask.
Thank you.
And we sitting here would like to know the answer to that from JFO. I believe Julie was contacting from Addison County. What's the name? Who's our consultant from Addison County that's been doing this for 3 days?
Deb Brighton.
Deb Brighton.
Right.
To be able to help conduct the analysis to answer the question that's being asked. And what has happened in the last 12 or 14 years is we haven't answered this question and we haven't addressed it.
Okay, so the first question is, what base are we starting from? Right? It was 75,000 was the income level, and I believe it was 100,000 for a house value.
It was, the original law said $75,000 in income, you paid based on your income. Above that, you paid on your house value, and that was a cliff. When you earn the extra buck, it was over. And this committee, which concluded that the cliff wasn't wise, we moved the number up to $90,000 because of inflation and people earning more money, and we made a slope. That was 14 years ago or 12 years ago, and we haven't done anything since, and we do not have an analysis. And we would like to see what's happened. We're expecting 4 proposals dealing with both income and appraisal levels.
I'm starting to figure out what base we're starting from before I start changing it. Senator Pearson.
Madam Chair, sometimes I speak McDonald, so maybe I can.
I have been there too, and it is very scary.
A translator is worth $1,000.
So my instinct is with Senator McDonald, but I, like you, Madam Chair, I'm a little confused about what he's saying. So Senator McDonald, are you, there's 2 variables that go into whether or not one qualifies as income sensitized. There's your income and its relationship to your property appraisal, right?
Yes, it used to be only one, but now there are 2.
I don't need a history lesson, actually. Just help me try to drill in here.
Yes or no?
Those 2.
Yes.
So those 2, we occasionally, I recall, we've adjusted the income so that to reflect a little bit of growth in wages. I think I'm not sure if we've adjusted the property value, but are you trying to get us to the point where we play with those variables so that there is a benefit to 80% of our taxpayers?
Yes.
Okay, that's, I think, what the chair was asking, and so maybe the question is, which variables and how do we move them so that 80% of homestead
And I think
homesteaders,
that's what Julia's
right? Is that-
going to talk to us about. So I'm
Okay.
gonna let Julia tell us what she's found out in her research.
Good afternoon, Julia.
Thank you, Julia, for hanging in here with us and returning.
Yeah, happy to be here. Julia Richter, Joint Fiscal Office. So I'll just start and I'll say we run a lot of scenarios where we've adjusted the income threshold and the house site value cap to try to figure out how to get so that 80% of Vermonters receive a property tax adjustment. And Senator Pearson just gave a great run through. There's really the different variables in terms of there's the income threshold, which currently is that 90,000. And then there's the house site value, which is currently the 400. You can use the income on up to 400,000 of your house site value if your income is below 90,000, and you can use it on 225,000 of your house site value if your income is above 90,000. So that's just a brief, I guess, refresher in terms of what we're talking about. So there is a document posted on your committee page under my name today, which plays with these different thresholds or values, and so that you can see that with the changes of these different variables, how many Vermonters or how many households are going to be receiving a property tax adjustment. Before getting into it too closely, I just want to, I'd like to take a step back and say that looking at current law for FY24, we would need about 29,000 more households to get a property tax adjustment in order to reach 80% of homeowners. And as we've spoken about previously, the reason that many some homeowners are not receiving a property tax adjustment or are not paying on income is because, in fact, it's cheaper for them to pay a property tax instead of the income tax for education. So we ran a lot of scenarios. We actually, on the document that I'm happy to walk through in more detail in a little bit, there's actually six scenarios on top of current law that tweak these different thresholds and values to show, what do these tweaks entail and how much would they cost and how many more homeowners would receive a property tax adjustment. But even getting rid of the 90,000 income thresholds completely, that brings up Vermonters to only 72% of households receiving a property tax adjustment, and that's because it still will be cheaper for the other households to pay on property instead of paying on income. And so then I was like, okay, 400,000. What if we increased the house site cap up to 4 million? That still would only cover 74% of all homeowners. And that would cost about 60 million. So there's another couple of ways that if the target is for 80% of Vermonters to receive a property tax adjustment, if that's the goal, you could give the option of the 15,000 house site exemption to higher income households. So for the 29,000 households that are needed to get to that 80%, this would amount to about 6 million in costs and would extend the credit to households making up to about 200,000. Another option would be to change the relationship between the property yield and the income yield. So increasing the property tax rate and decreasing the income tax rate. As I think that the committee is well aware, typically these proportions change the average tax bill in the different categories. So the income, the homestead property, and the non-homestead property change proportionately over time, either increasing by approximately the same percentage or decreasing. another way would be to change that proportion, if that is the goal of the committee. So I guess I'll pause there. I'm happy to walk through the chart on that we did put together per your request last week. I do want to just state on the record that this chart is really, it should be used as a way to compare alternative approaches, but not used as a forecast for anticipated revenues due to a number of caveats that we had to assume in the modeling. But I'll pause there. I'm happy to answer any questions or go into the table in more detail.
Okay,
So, Madam Chair.
yes.
Thank you, Julia, because you've certainly done some work for us to look at, and it's on a chart. I think we would benefit from seeing that, and maybe we would recognize some patterns or whatever. Excuse me?
It's here, it's on.
Yeah, well, it's-
iPad.
And Senator Hardy's probably been taking the closest look at this stuff in the last 12 months than anyone on the committee now. But let's take a look.
Well, right now, we've only got 10 minutes. And somewhere in the next week or so, we've got to set a property tax rate and a yield. And it looks like we're never going to get to 80% unless, you do away with any income threshold and cap the house site at 400,000, which is where we start giving you a surcharge if your house is vacant. We've got so many moving parts right now. And I don't know, it's Jello, and I don't know what the outcome will be if we push it. It sounds like there wasn't a time where 80% of the people saw their taxes reduced. If that's what you define paying based on your income was. It sounds like we set an income, $75,000 was a pretty decent income in the 1990s. In the 70s, it was 15,000. So it was a pretty decent income. And we said, you're going to be limited to paying X% of your income in your property tax under this. And it was a high enough income, so we whipped in the middle class. It was not a low income credit. We upped that. But trying to get it so that 80% of the people actually see their property taxes reduced, I'm uncomfortable with saying you've got unlimited income and you can have it reduced up to 400,000, and your house site can be worth up to 400,000, and that's going to cost $40 million, but only 72% of the people are actually going to see their property taxes reduced. I'm just struggling with that concept. So that made you just me, Senator Hardy.
I guess, Senator McDonald, is your goal to get to 80%? Is that, or is your goal to provide property tax relief or more equity? What's your specific goal? What problem are you trying to solve?
The goal is we have a certain amount of money to put into state aid education, and the question is who gets it. And we had a formula for who received it, and that used income as a guideline to get 80% of the money to those people. And we have not adjusted that in 12 or 14 years, and things have changed. And we haven't looked at it to see, during those 14 years, who's been the winners and who have been the losers during the change. And I'd like to know what's happened.
Okay.
Can I
And
ask Julia a
if we
question?
use the same amount of money that was in the ed fund and distributed it differently, what are the choices we might have?
Abby has to leave at 3. I just got notice. So Abby, do you have anything to add to this discussion that might shine a bright light on it and help us?
Thank you, Madam Chair. Yes, I do unfortunately have to leave the committee in about 5 minutes. I think Julie is really the best place to walk you through the different analyses and tweaking certain variables and what the result will be. I am happy to draft wherever you land, and I could do a couple of different options. I just have not proceeded to draft anything yet because I'm not sure which direction you'd like to move in.
I think that's an accurate assessment of where we are.
Yes.
Can I ask Julia some questions then?
Yes,
Abby.
I just want to make sure that Abby hadn't prepared something and give her a chance to give it to us. So, okay, Julia.
Thank you, Abby. Julia, have you, first of all, when was the last time we adjusted either the house site value or the income level?
So I just wanted to say our JFO Fiscal Facts has a great section in terms of history of property tax relief in case it's helpful, but I was just looking through here and it seems that the last time was in 2018 when
2019 or 2018? I'm sorry.
2018.
2018.
Yeah, and that was changing the house site value from 250,000 to 225 for those households with incomes over 90,000, and for those with incomes under 90,000, it was adjusting it from 500,000 down to 400,000.
Okay.
So we made the property value lower and
The house site value lower, correct? Yeah.
2018.
And then in 2016, there was a change in which the house site value was moved from 200,000 to 250,000 for households with incomes over 90,000.
How interesting. And do you have, or does that Fiscal Facts have a sort of breakdown of income bands and house site value bands? You know, at what income people are at and what house site value, so we can sort of see the stratification of who's receiving the ability to pay on income versus property?
It doesn't have that. Are you interested in understanding the size of the property tax credit in relation to the total property tax, or are you interested in the breakdown within the property tax payers?
Yeah, within the taxpayers, at what income level and the amounts of the property tax credit are they getting? But that's kind of a big job. That's a Deb Brighton probably question. But I'm just curious to see where we're at and what tweaks we could make, if any.
Okay, Julia, can you explain to us the system? Matt, we're not taking anybody in here but committee members. You're free to zoom in.
Right.
Okay, nobody's allowed in but committee members.
I don't understand, but okay.
Okay. You pay based on your income, which basically says, and what's the percentage? You're limited in a percentage of income you can pay in your property tax, right? And is it 2.5, 3/4, something like that? 2% plus your local share. Okay, so it's the state. All right, and that was the kind of base number we were using with Deb Brighton's pay on your income. Everybody would pay that too. And then And if I am not remembering the 400,000. I'm remembering several battles royal with the other body over, but you had people, we tried to ramp it out. So that's when the house value, I think, came in, and we said, okay, if you made 91,000, it would ramp out to your house value at $200,000 house. And that was a nice average house 15 years ago. I think arguably we might want to move that up. And then, and I think it may be gone when I wasn't here, but the house value came in when we started trying to ramp it down. What we always ran into is the elderly people that are now living on their pension and Social Security. So their income is down. But they still own the big family house. And so their house value is up. And they might be making 95,000 a year. I think, but it's up to that house value. If your house is worth 500,000, you pay the 2 3/4% of your income until you either reach that 2 3/4, and then you pay the full amount on either the 250, 200, and the 400, or anything over. Am I remembering correctly? So that at some point you pay the full tax value. And we have, I think it was 100,000, it might be 150 when we started, and we've moved that out to 2. I think it did get pushed back in part of an agreement with the other body. But we haven't upped the income level. The question is, if we say everybody, if we interpret pay based on your income means 80% of the people are going to get a reduced property tax, then I think what I heard you say is we have to move that income up a long way. Would be achieving, yeah, statistic, it's a very different ballgame than we're starting out with. We are moving the needle way up. And I'm not sure that's where we want to go. Senator Pearson.
Well, Madam Chair, what makes you say we're moving the needle way up? I mean, we're as I see this, we're starting to understand some of the moving parts. So maybe when you say that, you mean the 80% goal. But
I mean, when I'm saying if our goal is to have 80% of the people
sure
reduction, then
so
that's way up.
Well, so this chart from Julia is actually that we're currently seeing 63%. That's, I
Right.
thought it was closer to 67. So there's a long way between that and 80 that I think is worth exploring. As you said,
No problem in adjusting for inflation and inflationary house values. And yes, we tried to do that regularly. We will get pushback. But I'm going to have to be convinced that 80% of the people ever got their property tax reduced.
Well, but I mean, I'm not the one to convince you, but I guess at some level, maybe we could clearly do better than 63. Senator McDonald may not get everything he wants, but we could be moving in a direction that sort of honors the shape of the economy lately, and without having to panic that we're sort of blowing the roof off here, it seems to me.
And I think we could do a 20% increase. And that would get us to 68. If we basically say you can own a $400,000 house and there's no income cap, we still only get to 72%. So I don't know where 80 became a magic number. I think 80% of people in Vermont in 1998 or 99, when we did this, had incomes at or below $75,000. I think that's where the 80% came from. But I am not at all sure that that 80% saw their property taxes reduced. I think folks, I think if you were, depending on what you owned, if you were an elderly couple and owned a big house on College Street, you might. If you were living in a single wide, you might not. So I just want to make sure that we're not changing the goalpost.
Well, I guess I would just say, if we're not comfortable with 80%, let's not stop the discussion. There's a whole lot we could do that would be of significant value to a lot of middle class families, and that I guess, given this chart, 80% seems not the right metric to me, but I wouldn't want to toss this aside just because of that.
The question is, where is that median income? Where is the point at which 80% of Vermonters have wages at or below that level? Because I'm willing to bet that the 75, that's where that number came from.
Well, I think one of the reasons it strikes me as just so hard because it's not one metric. We know clearly where 80% income threshold falls, and we probably know where 80% home value falls, but where they intersect is evidently, according to this chart, hard and at high levels. But if we thought we were close to 80% qualified, and then we thought that meant roughly 70 or 68% could take advantage, and we're in fact at 63%, we're under 2/3 of our households who are able to take this benefit, and that's concerning to me, and new information. I should say. I think we had heard 68% was more where we were landing. So
I think it varies. Julia?
Yeah, thank you. I just want to, because we are talking about the table a little bit, I do want to add to the discussion that this table is really reflecting a number of assumptions that were needed in the modeling, which includes so it's been inflated. It's using previous data that's been inflated forward to FY24. The yields still haven't been set. There's a number of things in here which makes it so that we don't know if in FY24 it will be exactly 63% of households. So I just want to clarify that this is not a correction of previous numbers that we've discussed last week, but more just we included this first row as sort of so that you had an idea of, well, what, given all of the assumptions and the caveats of all of the things that we needed to do for the modeling, here's what the model is telling us for FY24, then here's what it's telling us for all of these other scenarios. But it still is, from our best estimates, the other numbers that we've presented previously remain our best estimates.
and this is modeling. So we know there's being rapid adjustment in the average home prices. We're seeing adjustment in wages. So this model, and then we've got the whole weighting thing, which could impact tax rates and a different set of homeowners. So this is a snapshot in time, given certain assumptions.
Yes.
Okay. Senator McDonald, and we've got Becky and another two topics.
I am, thank you, Julia, and this has been helpful for me, and thank you, Senator Hardy, because you've asked a couple of questions, and I'm asking to try and to look at this slightly differently. I keep using this 80% number, and that's kind of fuzzy. So it's a question I would try to ask. When we have the amount of money in the ed fund that's available to provide state education, we pour that money into the formula. It self-levels, as Senator Hardy has reminded us, and in the self-leveling, it has to conform to 90% income up to $400,000. And when you've done that, you have a percentage of the money, this pile of money that's gone into this leveling process. And I would like to ask us if we know what the percentage of that money that's going to the people who pay based on their income, and what percentage of this pie is going to the people above that level. Is that a conceptual?
What do you mean going to?
Well,
The money's going to schools.
it's going to establish what property taxes are on individual houses and up to two acres for the people that pay based on income. And it's going to the houses and the 2 acres of people that are above the income sensitized folks.
Right.
Okay. So if we know what the percentage that goes to those above the 80 and those that are part of the 80, how have those pie slices changed
Over time. I think
since
that is
in the
Deb
last
Brighton.
10 years? Pardon?
I think that's a Deb Brighton question.
And I think it answers all of our questions on how do we measure what we're doing now compared to how we used to do it, and are there any surprises? It may turn out that it hasn't changed, the percentages haven't changed at all.
That's essentially the question I asked Julia and then was interrupted in my line of questioning, so.
I've often found that if I have to ask twice, and then I have the luxury of Senator Pearson, who translates for me, and then and for many of us on occasion, and often gets us to what we're trying to ask. So that's my ask, Madam Chair.
I think those are good questions, Mark, and I think that this is part of the reason why we didn't have the capacity to take on the income tax funding for education this session. These are really big questions that hopefully Julia and Deb can work on. But if you have any of that data, Julia, that shows the income levels and property value, the slices of those, that would be helpful to see. I'm happy to talk to you in a chance when we can have like a full conversation and not in this atmosphere.
But I think things like property values is probably in property valuation, income levels is probably with the tax department, and that this is not going to be a small task. It is probably something, and we contract with Deb Brighton, that we'd have to ask for a contract, because it is, I think at least at this time of year, when I know what's going on in joint fiscal, more than I think they can do before we're out of here. We may want to talk about doing that over the summer. But the fact is that we are going to have to set a yield in the next week. And I want to first ask, I've got Becky Wasserman, and we want to get 159 out of here. And Becky, what is your time frame? Do I have time to let Julia just walk us through the Ed Fund outlook? Do you have some?
I do have a tighter schedule this afternoon, so I have about another 45 minutes.
Okay, so why don't we go to you and we'll see if we can get 159 out, because they needed that across the hall 4 days ago. And when I left on Wednesday, there was discussion about TIFs and whether or not, when I left, the discussion was whether or not we were going to leave TIFs in, we were going to pull them out and work on them some more, or, and I understand from the emails, and I have things on my desk, that there is a proposed amendment. So how do you leave it on
Senator
Wednesday?
Cummings? Pardon me, this is Faith. You should have 2 amendments on your desk.
Yes, I'm passing Ruth. Can you grab that one?
Just checking. Thank you.
1 of 3. All right, I don't have this one. You have an S, all right, 2 over there, all right.
They're on the website, right?
Okay, yeah, but I can't get on the website and talk to Faith at the same time. Here you go. All right, so we got extras. Okay. And I've got another one. Right? Yeah, 1, 2. Here's 2 down there. And 2, so Becky, why don't, I'm assuming I've got 1 from Senator Pearson. And another one that looks like it's just a committee bill. Yes, I have 2.
Yes, I do.
Here you go. You need more.
Here, Randy.
You have.
So, yeah, so there should be 2. There's 1 from Senator Pearson and 1 that's drafted as a committee amendment.
Okay.
One that's a committee amendment is reflecting all of the proposed changes from VEPSI that are all technical changes. And so I can go through that. I can also go through Senator Pearson's amendment. I don't know if the senator wants to speak about before, but I can do whichever first the committee wants me to go through.
You want to tell us about your amendment, and then I think we probably can knock off technical changes fairly quickly.
Sure, happy to, Madam Chair, and this is partly what I was hoping for and partly what I sort of saw getting reflected in our conversation, mostly after you had to leave the other day. There were a couple salient facts that came out. Oh, now I'm just struggling to find it here. Hold on. So the first was in these project-based TIFs that the reporting and audit requirements were different than the big TIFs. They were to be run or contracted out by the municipality. And so that was concerning for me, and I think some others. And so this just tries to loop it into the standard process that is run by the auditor. Now, we know that those are onerous TIF audits and can be costly for the towns. But I guess at this point, I have some confidence that the audit would be commensurate to the dollar value of the projects. And so that was the beginning. The next was in the section about the current large TIFs. There was a shift to say that projects had to, you were still here for this, Madam Chair, projects had to qualify for one of the three, which was a change. They currently have to qualify for two of the three. And so this was restoring the status quo where they would stick with two of the three for reasons I think you and the rest of us understood. So
committee, questions on this one? It basically makes it clear who's doing the audit. Which just said there would be an audit, wasn't clear if it was by their elected board of auditors or a professional outside auditor or the auditor. This makes it clear that there's an annual report and then a final audit by the auditor. Okay, Senator Pearson, you have.
Well, just a question for Becky. I don't believe the auditor does an audit of the normal TIFs, jumbo TIFs every year. And so that was a question I had about this language. And maybe it reflects me not following the bill as it's in front of us closely, but it would not be my intention necessarily to make this way more onerous than the regular TIF. So just a point of something I wanted to be clear on and we should maybe discuss.
Yeah, so this would, so the bill as currently drafted had the audit happening annually until the end of the period for which the education tax increment was being retained, so 20 years. And this was, the way it's drafted right now is having the state auditor do this annually because that's how it was when it was the municipality doing it. So I think that would be a question of if the auditor, the state auditor is doing it, how often you want that done.
Okay, there is a once every so many years. I remember all the scheduling with Burlington last year.
I remember that.
It's, yeah, so
I don't think
anyway.
you want to do a performance audit of this type every year. This is much too onerous, particularly if you're talking about smaller projects.
Yeah.
And is this for the big tips or the mini tips?
This is the mini tips.
Can we do a mini audit of the mini tips with a very small auditor?
That's a question of Becky.
Yes, okay.
So Senator Pearson and Becky, was this tried to reflect the comments of the state auditor? Because I agreed with that. I don't think he wants to do it every year.
Yeah, it is for me. And I had just said that we should treat this the way we do the regular TIFs. But the annually thing is a question mark. So that I'm not sure how to do that.
So currently in statutes there's an audit specific schedule for the Burlington TIFs and for the TIFs that are created prior to 2006. But for all other municipalities, an audit is conducted 5 years after the first debt is incurred, and a second audit 7 years after completion of the first audit, and then a final audit conducted at the end of the period for retention of education increment. So I can amend the language to reflect that schedule because I think that might most closely represent be analogous to the project-based TIFs because the other ones are more specific to the sort of pre-statutory TIFs and the Burlington situation.
Yeah. Yeah. The idea with the statute was that everybody played by the same rules and knew what they were. So I think that would work. Okay. Anybody have a problem with that? And after 5 years after the first debt is acquired, which Senator Sorokin, does these mini chips work? You've got 5 years in which to incur debt?
I think that's, Becky would be the
I
authority.
believe it's actually 3 years that you have to incur debt.
Okay. All right, so 5 years out. And then it's, yeah, I guess we're looking at, if you're thinking of bonding and not short-term borrowing, watch the Boston accent. You would want to keep it on that 5 years and then 7 years, but 5 years after the first debt is incurred. And then 7 years after that, and then a final closeout audit.
Yeah, so there would be three total audits.
Yeah. If they in fact went the 20 years. If they did some other form of borrowing, or this was part of a bigger financial package and they paid off the TIF section, then I'm assuming there would just be an audit of that, a closeout audit. If they paid it off in 10 years, you do one in 7, 3, 8 years, and then if you paid it off in 10 or 15, you go right to the closeout. Okay.
Yeah, I think if it was paid off sooner, you would not be doing that second audit after 7 years. It would probably just be that final audit at the end of the period that education increment is retained.
Okay. Does that work? All right. And then the last one was just restoring the 3, to do 2 out of 3 criteria. And I like that.
And I ran it by my committee this morning because I said, we admit we missed it. I don't know how I got in the bill. Quite frankly, no one ever explained that to us, and there it was.
Fine print.
Yeah.
Okay, so Becky, can you draft that up in a few minutes?
Or do you want me to go over the other amendment and combine the two?
Yeah, let's do that. So what is and this was said, this I wasn't here for. These are technical corrections from VEPSI. I think I left just as they were starting.
Yeah, so I would characterize all of these as technical and clarifications. There's some duplicative language that's being struck out. So this is draft 1.3 of H159, the amendment from the committee as a whole.
Okay.
So I can walk through these, but the first instance of amendment is striking out subdivision F2 in the last sentence, and that is just a sentence that is duplicated.
Okay.
The next change is in subsection E. There is a list of what VEPSI takes into account when it reviews applications. And there is language that's in another section of a bill that reads that VEPSI will look at the nexus between the improvement and the expected development and redevelopment for the project and expected outcomes in the TIF project zone. And this is actually something that's part of that review process. It's just in the wrong part of the bill. So that is moving this to the correct part of the bill.
Okay.
The third instance of amendment is fixing a mistake where there was language that is struck out and still in the bill. So it's actually just removing it from the bill. The fourth instance of amendment, just double check this one, is I think is where the language that was moved to that approval process. Let's see, it's subdivision 3B. So that is where that language that was moved to the approval process in the second instance of amendment is coming from. So it's striking it out of that section and putting it in the appropriate section.
Okay.
The fifth instance of amendment is has to do with an annual reporting requirement. I think right now it says that a report would be
Madam Chair.
submitted.
Yes, Senator Pearson is a
Could I
question.
just jump into that last one? And I'm just struggling. I'm now following the language, but the fourth instance there where we're striking out I3,
Mhm.
then you said, and we put it in the, we put it in the, you put it in the appropriate section, I think. Where is that?
So that is in the second instance of amendment. I'm re-adding that language in the second instance of amendment, and
I
it is
see.
going in the section that deals with how VEPSI approves an application.
Okay, and are these amendments, did they all come from VEPSI or where did they originate?
They did, and they are some of them are things I had also noticed were just mistakes in the bill that needed to be corrected.
Okay, thank you.
Okay.
The next change is in subsection K, which is the reporting requirement. A municipality has to submit certain reports to VEPSI, and one of those reports is due February 15th. And the change is making it due October 1st, and that is because, as I understand it, there's an annual report due from VEPSI to the legislature in January of each year, and VEPSI would not have the information to submit to the legislature if the municipalities are submitting it in February. So it is moving back the timeline that the municipalities give VEPSI.
All right.
Sorry.
Okay. You're moving it back, not forward.
Yeah, moving it back so that VEPSI would have the information for their January report to the legislature.
Okay.
The sixth instance of amendment, the sixth instance of amendment is striking out an extra word that was left in there. The reporting change was from April to January, and the April was inadvertently left in the bill as struck out language. So it's just, that was just a mistake there. And then the seventh instance of amendment is was cleaning up some of the audit language. This will obviously change because I am adding in the audit language from Senator Pearson's amendment. So I will work on this section to reflect what the committee just discussed about the audit schedule.
Okay.
And that was it. So I think the only change I have to make here is in the seventh instance of amendment is to put the new audit language in.
Okay.
Well, if you're gonna combine them, you also have to do the strike all in Senator Pearson's second instance.
Oh, yes, and I'll add that in as well.
Have you got time to get that done this afternoon?
I can get it to you before, well, I don't want to overpromise editing, but I should be able to get it done before 4 o'clock.
Okay, I'm gonna let you go. We can go back, or we're gonna go, we've got some revenue options and other things for the committee to talk about, so just let us know. I think we can vote it if it hasn't been through editing, but
Sure, I can send you a copy, but at the same time that I send it to editing, so that you can vote on it.
then we'll just have to wait for a clean copy to take upstairs. Okay.
Okay, great.
I haven't been down today. All right, good. Okay, committee. I was really hoping that Graham would be well enough to be here today, but he isn't. We've got to do some revenue raising. And the big one is the child tax credit, which is somewhere in the neighborhood of $40 million. There are other adjustments going on. They're not going to call the committee of conference for the corporate income tax because there's floating pieces in there. We both came in making some money, which I've been told the governor doesn't like. But we're more positive than they are because we did not do the single sales factor, which the other body really wants, which means we will have to raise some money. We've also been told that the governor absolutely hates, not just dislikes, the new corporate minimum tax structure. So, and that's how the other body raised some money. They also did the flat $10,000 pension exemption. We put income caps on that so that everybody was treated the same, as close to equally as we could make it. I think the House would like to go back. I've told them that equity was important to this committee. We weren't going to roll over and play dead on that one. It was something we talked about a lot. But there's moving income pieces. Graham has worked out a couple of scenarios, and the thing for us to talk about is the child tax credit. We can raise $6 million with that mutual fund increase, which is in there. The House has also booked the $2.8 million in that 1% property transfer tax surcharge. So we've got that hanging out there with nothing at this point, but the manufacturing equipment tax, which is sales tax. The property transfer tax, I believe they have dedicated it to go to the general fund. But that's not an ideal. Oh, and to start with, all the budgets that came out were not balanced by tens of millions of dollars, starting with the governor and going through the House. So we are the dead end. And we always balance our budgets in Vermont, but and plus all kinds of new revenue requests are coming in. We've got what, 2 pages of them, Ruth, in health and welfare?
I think it's more than that.
Yeah, and they're all good things. We also have
You mean spending requests or?
spending money. Nobody requests to give us money. Everybody needs money. And it's falling on the chair of appropriations to be the wicked witch of the north and tell them the money's gone. But a lot of them are good. And I know Probst is trying to get a 10%. The governor did 3, the House did 7. I know Probst is trying to get to 10 for those community-based services, mental health, home health. And this morning we were listening to the developmental services, Champlain. Remember what it was Champlain Communities. But they basically do residential homes for people with severe developmental disabilities. They are also in that home and community-based services, so that's where we are. Senator Pearson.
Madam Chair, you often remind us to stick to our jurisdiction. Do you have a proposal on the child tax credit? I've heard of different ideas floating around.
4 of them. I think the base question is that, and then we can look at Graham when he comes back, his proposal. Right now, it's tied. The question is, if you can't do something for everybody, who do you want to do something for? And if that's lower income, and pick 100,000, but probably the lower half of the income scale, then how do you do that? There is wisdom in having it not be a welfare program, because then when you cut it, everybody's got, it's the theory that went into the property tax rebate 80%. You wanted the majority of people to be invested in that benefit, because that gave it some, it wouldn't be as easy to cut it back in a few years. And we haven't. We probably haven't moved the numbers up as quickly as we should. And so that's the question. And then the other question is, to me, it was very revealing when the tax commissioner said, okay, you're tying it to kids under 6. If you have $200,000 family income and you've got 2 kids under 6, you're going to get $2,800 in a check. If you're making $75,000 in income and you have 3 kids over the age of 6, you're getting nothing. And is that what we want to do? Or the scenarios I saw Graham work out, and I think they collected them because I didn't want them flying around, is do you, rather than talk about children, do you talk about households or families? And yeah, I don't have it. And then that could give you, let's see, I do have it. Okay, I do have Graham's proposal. So.
Wait, is this on our?
No, this was, he put this together for a meeting with the chair of Probst and I, just because I'm trying to get an idea as to how much money we need to raise. And this is what I thought he was going to present, but I don't think it's not on our, it didn't come in to go on the website. But the income tax brackets, yeah, he's laid it all out. The percentage of kids, he said other ideas is the House version, except with a $1,000 tax credit instead of a $1,200 tax credit. That total would be 40 million as opposed to 50. You could do a threshold of 150 instead of 200, and that would cost you 44. Or you could also drop the age to 5. Once kids are 6, they're in school and they'll get other services. But then there was also a discussion of, yeah, there we go. This is a refundable tax credit. And that's the house. The child says $1,200 refundable tax credit for each child 6 and under. Full credit up to 200,000 adjusted gross income. Phases out quickly after 200,000. It costs 48 million.
Is that envisioned as a base builder, or is this just 1 year in responsibility?
No, this is ongoing costs. This is $50 million a year. So it's a lot of money.
I think that one of the issues in all this, you know, we always look at, well, what's the likelihood of a veto and so on and so forth. And where this deviates is by putting all of these eggs in the childcare basket. There are all these other constituencies that are left with nothing. And the administration's original proposal was to, in fact, they had a proposal to spend about the same amount of money, but it was distributed much more broadly because there's so many people and things that are left out. And then when you take a look at the total, my understanding, I heard today, I don't know, this is all anecdotal, that the House number has gone down to about 29 million. I don't know if that's the case in terms of what's going on in the committees.
This one I haven't heard.
I think that's the,
universal.
the universal meals number.
Yes.
Yeah, that's,
But notwithstanding that, the whole issue is by putting all this money in the child tax care credit, in the tax credit for child care, for children,
Yeah, it's not.
but without addressing any of these other needs. That was problem one. And then obviously problem two is the high salary level, the high income level that it would apply to. In other words, it doesn't appear to be very well means tested at all. And there are lots of people who you question whether you want to give somebody who's got $220,000 income a credit of that type in the first place, given the other needs that are left unmet. I mean, I can't imagine this not surviving the veto.
well, I think
the way
that's
we're talking about.
what we asked joint fiscal to come up with some scenarios, and Senator Bray,
Yeah,
Bray and Brock are throwing me these days.
Senator Brock has said, I think in part what I was going to say on the levels, I'm somewhat astounded when area median income is 62,000 or something like that for the state average. Then I hear 200, I can't square those at all.
Yeah.
Like if it's really about assisting people on the lower end of the income scale, you could say, oh, well, the threshold is 62 and put your money there. And, you know, you can hear all sorts of stories, but people make choices about what kind of level of income they need to support a lifestyle of a certain sort. And I start to feel like we're way out of whack when it comes to look how the average family lives and then where our benefit packages go.
So let me tell you what joint fiscal came up with. And they're all spending roughly the same amount of money, but we can adjust all kinds of numbers to bring that down. The first thing they did is a $1,400 refundable tax credit for taxpayers below 25,000 AGI. So that's the bottom.
Is that available to us so we can see
No,
it?
that's why, that's what we lost when we lost Grant. And I will, and I don't even have it on my computer. I have one hard copy.
Make a copy of it, copies of it. So we can-
I don't know that we could, but let me just tell you what they are. And he will have copies and it will be posted when hopefully he's back on Tuesday. But the other ones got away from the child credit and said we could give for the same money, we could give $1,400 to people below an AGI and then phase it out over $50 for every $10,000 of income and credit up to 305. So at 305, you might get a $10 credit or a $5 credit. But the idea is you set an amount, you set an income level, and then you ramp it, and you can adjust the slant, the ramp, or you can, and you can adjust the levels that you go to. That way, the credit goes based on household income, not on the number of children you have. And if we decide we want to spend more, we change the numbers or change the ramp, or we want to spend less, which is more likely. You can also, let's see.
So can I ask a question too? You had said something about when the benefit goes up to higher levels, it makes it less subject to being repealed or cut or trimmed in subsequent years, but that, I don't know that I would want to use that as a principle for setting the levels.
No.
I mean, I understand how that, but that feels more like politics than a need assessment.
Well, we're saying that level right now is 90,000 for property tax, so.
So I was just, I think we should ask the House to talk to us about how they arrived at this, but the broad-based taxes or broad-based benefits are more sustainable with public opinion. That's why Social Security, Medicare, all of those are really popular, broadly popular with so many people, and basically untouchable because of that. So I think that's part of their thinking or their goal with this, is that it would not be just focused on low income people. That's a policy decision, and I'm not defending it, but I think that that's part of their thinking. And then part of the thinking with the very focused tax credit on families with young children is that will get you the biggest bang for the buck, because that's where most of the poverty is, and that's where most of the need is, and that you can actually do a lot more good by having a very focused tax credit on a very needy population. And the tax credit would be large enough that these families would actually be able to do something and have a big impact on the level of income they have available. So I think those are the two sort of principles that they're working with, and whether you agree with them or disagree with them, it's a policy decision. And while broad-based, tax cuts may be, small ones that hit small sections of the society, it's just a different approach. But there's a lot of research behind this early childhood tax credit, and it basically also was modeled after what the feds did. And I'm not saying that I agree with it all, I'm just saying that these are some of the philosophy behind it, and I do think there's a lot of evidence to show that it's really effective and more impactful than most of the other tax cuts or tax credits that we could come up with in terms of impact on the people who are receiving it.
And the numbers on the federal tax credit, a huge amount of children are lifted out of poverty.
Yes.
And that's gone away. The question is what the House didn't do. It's a wonderful idea. They just didn't fund it. So it's come to us with a bill.
I think the budget they passed was, we checked with the chair of appropriations. I believe Senator Pearson asked her yesterday, and I believe she said that it was
partly, there was some money in there, but it's not funded.
Madam Chair, this is a really salient point, and we've got to get it correct. Senator Kitchell told us point blank, the House accommodated that 48 million in their budget, and that makes sense to me, because it would be totally shocking and a complete breach if they didn't. But you've thought otherwise, so I don't know who could tell us.
Let me look at child tax credit. Okay, they put 48 million in. All right. But this was the box that Senator Kitchell gave us. We have so far spent 93.93 million on military retirement, 1.67. That's the House. No, we did 0.45 on
decimal point.
yeah, on pensions. We have done nothing so far in the Social Security exemption because that's also attached to the child care bill, but that's another almost 2 million. We have done, it'll be 0.75 million for the manufactured housing credits. We have done 2 million for the downtown tax credits. We lost some money for throwback, but we picked it up. Overall, we did all right. But the property transfer surcharge, the House booked, that's the 1%. The House booked 2.8 million on that. We have booked nothing. CSRS exemption, we did 0.4, oh, that's, I think the pensions, no, military survivors.
I think it would be helpful to have Graham walk us through that.
Yeah, well, that's why, that's what was supposed to happen
But
today. Graham got sick.
I understand that. I hope he feels better. I just feel like you reading it,
very hard.
it's a lot
Well,
of.
this is what Jane went over with us too.
Misinformation, and we're being recorded live on YouTube, and I just don't want to have misinformation out there, or for us to make decisions based on a misunderstanding of the information that only one of us has.
We aren't making any decisions. I'm trying to figure out what direction the committee wants to go.
We don't have full information to make it, and this is a really difficult conversation to have about really important stuff without full information.
Okay,
So
then, all right. I can adjourn this committee right now if the committee does not want to talk about things until they know everything there is to know. But we've got time. We're waiting for the bill to get drafted. And we can take a recess and you can walk down the hall. Becky, have you got?
Sorry?
Have you got the amendment? Can you send it to the State House, the printer here, so we have a hard copy?
Sure.
And then Senator McDonald will have a copy.
Becky, I can do it.
Can you, Faith, have you got it?
I don't have it yet, but if she sends it to me.
Becky sends it to you.
I sent it to you both. I can.
Let me see if I can find it.
Email is incredibly slow this afternoon, so I'm sure it will show up.
Email's hell on Friday afternoon.
All right.
All the
Sorry,
servers are tired.
How many copies do you need?
If it can be posted, then we don't need it.
And you can, if you share your screen, we just need one copy to go up with the bill. I think we have one coming and I hope about 50 seconds.
Okay,
We're
so
just getting
I'll
a
ask.
copy.
I'll stop it.
I'll ask them to make one copy.
Well, Faith can just, if you email it to Faith, she can print it on the printer.
Oh,
here,
okay. Yeah, I did
and
email.
then we'll have a copy to go up with the bill.
Yes, I emailed it. I think it's just really slow, so I can share it for now.
So if you share your screen, then we can just see what you did and what we've agreed to. And Senator, you get your sheets.
See if there's a more formal copy.
Okay, they're not up there.
Just one or two there.
Okay.
H.
I think I just need screen sharing capabilities.
Okay,
In any event, Madam Chair, we'll get it up there.
okay, well, I think I'm gonna ask Senator Sirotkin to do it since it's his bill, and I sent, I think it was Digger to you today, Michael, because they wanted to know about the millions or hundreds of millions of dollars in the bill, and I told them, oh, Dr. Michael, I'll talk to you about tips.
Great.
Okay, here we go.
Okay, so Becky Wasserman, Legislative Counsel. This is draft 1.4 of the Committee on Finance's amendment to H 159. And so the changes that I made are in the 7th and 8th instance of amendment. In the 7th instance of amendment, I've struck out in the underlying bill subsection M, which deals with the audits. So in subdivision 1, it's the language that you previously saw in Senator Pearson's amendment about the state auditor of accounts conducting the performance audits. And then rather than having it annually by April 1st each year in subdivision 2, I have added a schedule for the audits that are to be conducted in the subdivision. So the first audit is 5 years after the first debt is incurred. The second is 7 years after completion of the first audit. And then the final audit will be conducted at the end of the period for retention of education increment. And then the 8th instance of amendment is striking out the section that changes the project criteria to 1 out of 3. And so what will remain is current law with the 2 out of 3 criteria.
Okay,
And that is for the TIF districts, and the audits are for the project-based TIFs.
right.
And Becky, do we still have the annual, guarantee, ensure that the tax increment financing project count required by blah, 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 that section is not implicated, is that right? Because there are these, on page 34, there are these annual obligations. So I just want to make sure we didn't cross that up.
That is in subsection K, so that is not being crossed out. So the audit is in subsection M. What you did change in subsection K is the 5th instance of amendment right here, where it talks about the
date change, okay.
The date change from when the municipality has to submit certain information to VEPC, but otherwise that whole subsection still remains.
Okay. Questions? So these are the technical changes plus the audit schedule, which is not the auditor. Of course, we could do that. The auditor might get upset. But putting these on the same auditing schedule as a regular TIF, and we've struck out the proposal that a regular TIF just have to meet 1 criteria. And I think that's it. Senator Sirotkin.
If you go down, I'll move the amendments so I can see the reference.
Oh, okay. No, we need the top, the date and the draft number, so.
Draft 1.4, 4822, 3:50 p.m.
Yes.
Got it.
So I
That's
move-
correct.
So I move that we amend H 159 as drafted in draft number 1.4.
Okay. Is there further, Senator Sirotkin has moved that we amend 159 with the draft we have just looked at, with all the numbers he just said. And is there further discussion? If not, all those in favor say aye. Opposed say no. I'm seeing that 0. Now I need a motion to approve with as amended.
So moved, Madam Chair.
Senator Sorokin has moved that we approve 159 as amended. Further discussion? Not, all those in favor say aye.
Aye.
Opposed say no. That carries 7-0. Senator Sorokin, you can take it up. And Senator McDonald has that. What we haven't,
We don't have a hard copy of it, right?
we don't have a hard.
Yeah. And this, sorry to interrupt. This is also not the edited version, so I can send that to Senator Sorokin as soon as it's available.
Okay, I guess you can't send it up to the,
So if I get it on my computer, I can put it up right here.
yeah, they can print it out. It's
My
not
one was
the
yes
audit
on
version.
pieces I like and sort of okay on the rest. That's the way you always are.
Yeah, I don't really like the bill, but we're just voting on it.
And if you get the section, you can edit a little bit.
Don't joke.
Let me help you.
There have been rumors.
I sometimes wonder, once upon a time, very long ago.
Pocket vetoes, okay.
You know, it's interesting, and I, just for the committee's information, there was the letter, of course, that
I think we can go off live.
Okay.
So Faith, we are done for today. We're just